$800 billion. The number on your screen right now, I want you to sit with it for a second. Here's $1,000 and $100 bills. It fits easily in your wallet. $1 million, what many consider enough to make you wealthy, stacks about 4 feet high, roughly the height of a 4-year-old child. With $800 billion, that same stack of $100 bills would stretch from New York to Columbus, Ohio. Over 500 miles of $100 bills stacked one on top of another. That is Elon Musk's approximate net worth as of this recording. He is widely projected to become the world's first trillionaire. Jeff Bezos has crossed $200 billion. Larry Page, Mark Zuckerberg, Larry Ellison. The list of people who have accumulated wealth measured in hundreds of billions has grown in a single generation in a way that has no historical precedent. I want to ask you a question that I think is more interesting than the one you usually hear. The usual question is, did these people deserve it? That's a values question, and people will disagree. Here's a better question, a market question. If there was that much money to be made, why didn't competition distribute it? Why didn't other entrepreneurs, other investors, other companies look at those returns and rush in to capture some of them? That's what's supposed to happen in a free market. Extraordinary profit is a signal. It attracts competitors. Competition erodes excess returns and spreads the gains more broadly. So why didn't it? Is Elon Musk so singularly exceptional, so uniquely irreplaceable, that no other human being on Earth could have built a competing rocket company or a competing electric vehicle company and capture some of that value? Are Jeff Bezos' logistics insights so one of a kind that the entire global economy couldn't produce a single serious competitor? Is Google the only useful search engine? Or is something else going on? Before we go further, I want to address something you'll see often around social media that says, none of your problems are because someone else is a billionaire. There's a version of that argument that sounds reasonable. It suggests that wealth is created, not taken, and if someone else having more doesn't mean you have less. I understand the instinct. But here's why it doesn't hold at this scale. The wealth of a company is largely a function of its profits, and profits are what's left over after costs, including wages. When a company suppresses worker wages below what a truly competitive labor market would produce, those wages don't disappear. They add to profits. They flow to shareholders. They get capitalized into the stock price. They become the net worth of the people at the top. So yes, the connection between suppressed wages and concentrated wealth at the top is direct, documented, and arithmetic. It's not a grievance, it's accounting. Before we look at what's happening, let's establish what's supposed to happen. Because the argument I'm making is not that markets are bad or capitalism is wrong. It's quite the opposite. In a genuinely free market, here's the basic logic. Someone spots an opportunity, takes a risk, builds something valuable, and profits from it. That profit signals to everyone else, competitors, entrepreneurs, investors, that money is being made here. They compete. Supply rises to meet demand. Prices fall toward the true cost of production. Wages rise to reflect the true value workers create. And over time, those excess returns get competed away and distributed more broadly through market forces. New entrants get a shot. Gains flow toward contribution rather than toward whoever got there first and then locked the door. That's Adam Smith, the invisible hand. That's the mechanism that's supposed to make capitalism work, and not just for the people at top, but for everyone. Competition is the engine. It's what prevents any single player from capturing too much, holding it indefinitely, and converting economic power into political power. For this to work, policy has to actively support competition in product markets and labor markets equally. Rules must be designed to keep the playing field level, not tilt it toward one set of players over another. When policy holds that line, the rest follows naturally. Firms competing for customers need better workers. Employers bid wages up toward the true value workers actually create. Workers gain real options because multiple employers are competing for their skills. When those conditions hold, you get a market that behaves roughly as the theory predicts. Some people get rich, innovation gets rewarded, wealth reflects risk and contribution, at least approximately. The system isn't perfect, it never is, but it's self-correcting. Competition does the work. Now here's the issue. We are nowhere near those conditions, and the distance isn't random noise. It isn't markets being imperfect in the ordinary way all markets are imperfect. The distance is a result of specific policy decisions made at specific moments in history that systematically push the scales in the same direction, toward capital and ownership and away from competition and labor. Think of the market as a scale. On one side, businesses, ownership, products. On the other, workers and consumers. When a scale is balanced, the market does its job. Prices reflect reality. Wages reflect contribution. New entrants can compete. Policy can add weight to either side. Add enough weight to the business side and the scales tip. Competition gets blocked, labor loses bargaining power, wealth concentrates faster than markets can redistribute it. Add too much weight to the other side and you get different problems. Reduced investment, less innovation, capital that doesn't flow toward productive use. My argument is that the scale is tipped dramatically through a series of identifiable policy decisions, and that many people saw it happening but lacked the incentive to reverse it, because the same concentration of wealth that resulted from those decisions also purchased the political influence to entrench them. Let's clarify one concept. Truly free markets have never existed and never will. It's impossible. The idea of a free market is a theoretical construct. In practice, markets are always embedded in legal structures, regulations, property rights, contracts, enforcement mechanisms. That's not a flaw, it's a necessity. But the debate is not free markets versus socialism. The question is, which interests do the rules serve, and does the policy environment allow markets to behave as freely as possible? Or does it tilt the playing field for a specific set of winners? Let's look specifically at how the tilt was built. There are several policy mechanisms that add weight to the capital side of the scale, that act to block the competitive pressure which would otherwise distribute gains more broadly. I'm going to walk through some of them. Intellectual property law, government contracts and subsidies, tax policy, bailouts, antitrust non-enforcement, and campaign finance. None of these are inherently illegitimate. Most have a reasonable justification at their origin. What I'm going to show you is how, in practice and at scale, each has been calibrated to pick winners, and how, taken together, they all shift the balance to the same side. Start with intellectual property, patents, copyrights, and trademarks. In a truly free market, if you invent something useful, competitors can copy it, improve on it, and drive your price down toward the actual cost of production. That's the mechanism that distributes gains broadly. IP law says no. For up to 20 years on a patent, you have exclusive legal right to your invention. The government will enforce that monopoly for you. That's a government-designed barrier to competition, justified on the grounds that without it, there'd be less incentive to innovate. And that justification has real merit in principle. Temporary monopoly in exchange for eventual public access and more innovation is necessary to promote investment in research and development. The problem is how it is often used in practice. Take Sovaldi, Gilead's hepatitis C drug. The medication costs the consumer approximately $1,000 per pill in the United States, roughly $84,000 for a full course of treatment. The manufacturing cost is about $1 to $3 per pill. Generic versions are available in India for under $100 for the full course. Many people would argue that the fees are justified to recover their research cost, which is a logical argument. But here's what makes this example particularly striking. Gilead didn't develop Sovaldi. The drug was invented by a scientist at a small company called Pharmasset, funded largely by $880 million in NIH grants, National Institute of Health, taxpayer money. Gilead acquired Pharmasset in 2012 after the drug had already completed successful human trials. Gilead bought a finished product that was funded by taxpayers, attached a patent, and priced it to generate billions of dollars of revenue for itself. and then they evergreened it. When Sovaldi patent began approaching expiration, Gilead combined the drug with a second compound and launched Harvoni, a new drug requiring a new patent. That combination patent extended Gilead's monopoly by an additional 7 years, pushing exclusivity to 2032. No new breakthrough, no new molecule, just a new patent. By the time all of Gilead's patents on this drug expire, they will have maintained monopoly pricing on a taxpayer-funded invention for over 2 decades. That's not IP law rewarding innovation. That's IP law being used to extract maximum rent from a discovery that someone else made with money the public provided. And Gilead isn't alone. A 2020 study found that every one of the 356 drugs approved by the FDA between 2010 and 2019 benefited from taxpayer-funded research. Critics will say research and development is expensive and risky, and without patent protection, pharmaceutical companies wouldn't develop new drugs. There is real merit in that, but the argument assumes the current IP terms are calibrated to incentivize innovation. The evidence suggests they're calibrated to maximize revenue extraction. Pharmaceutical companies spend more on marketing and stock buybacks than on R&D in many years. They become experts at evergreening, making minor modifications to drugs nearing patent expiration to reset the clock. A slightly different coating, a new dosage formulation, a combination pill. None of these represent meaningful innovation. All of them extend the monopoly pricing by a decade or more. And then there are patent trolls, perhaps the purest proof that IP law has drifted completely from its stated purpose. Patent trolls are shell companies that acquire patents solely as legal weapons. They produce nothing. They employ almost no one. They create no innovation. Their entire business model built on threatening to sue companies that are actually building things until those companies pay to make lawsuits go away. The numbers are documented and striking. Patent trolls account for nearly 60% of all patent-related litigation and extract more than $29 billion in direct costs from targeted companies every year. But the deeper damage is the chilling effect. Companies that settle with or lose to patent trolls reduce their R&D investment by an average of over $160 million in the 2 years following the payment. Entire technology directions get abandoned, not because the ideas weren't good, but because the legal risks made them too expensive to pursue. The system designed to incentivize innovation is being used to fund its suppression. Let's shift to another way that government intervenes in the markets, through government's contracts and subsidies. In 2008, SpaceX was weeks away from bankruptcy. 3 consecutive Falcon 1 launches had failed. The company was burning cash and running out of runway. Elon Musk had described this period as the darkest of his life. What saved SpaceX was not the market. It was a $1.6 billion NASA contract awarded in December of 2008. The government decided, using taxpayer money, that SpaceX was worth saving. Without that decision, there is no SpaceX. There is no subsequent trillion-dollar valuation. There is no Starlink. The company that is today held up as a preeminent example of disruptive private enterprise would not exist without a federal government intervention at the moment of highest fragility. SpaceX has since received billions more from NASA and the Department of Defense. It is, by any honest accounting, substantially a creature of public capital allocation. That doesn't diminish the genuine engineering achievements. It does, however, fundamentally alter the free market success narrative. Tesla is another case, benefiting from hundreds of millions of dollars in Department of Energy loans during its early survival years, billions in emissions regulatory credits sold to other automakers, credits that only exist because of government environmental policy, a federal EV tax credit that expanded Tesla's market in ways no private entity created. Additionally, Tesla competed in a market where every legacy automaker was legally constrained from doing what Tesla did freely: sell directly to consumers. Dealer franchise laws, passed state by state, heavily lobbied by dealer associations, require manufacturers like Ford, GM, and Toyota to sell through independent franchise dealers. Tesla was exempt. That exemption gave Tesla a direct-to-consumer advantage during exactly the years it needed to build scale, brand loyalty, and a national service infrastructure. By the time some states began closing that window, Tesla had already built the moat. The advantage didn't need to be permanent, it just needed to last long enough, and that window was shut for others who could have entered the market. But this pattern extends far beyond just Elon Musk. Jeff Bezos built Amazon's logistics infrastructure on the back of preferential U.S. Postal Service shipping rates, rates that independent analysis suggested were below cost, effectively subsidizing Amazon's shipping at public expense for years. Also, when Amazon ran its HQ2 competition to see where it could host a second headquarters, cities bid against each other with public money. New York offered $3 billion in tax incentives. Virginia offered $750 million. The world's richest man at the time extracted $750 million in public subsidies from a state government to locate offices his company was going to build somewhere anyway. States and localities hand out up to $95 billion in corporate subsidies every year. Not to struggling startups, to the largest, most profitable companies in America. Boeing, $16 billion since 2000. IBM collected $660 million in a single year while posting an $8.1 billion profit and cutting worker pensions that same year. Warren Buffett's Berkshire Hathaway, the company built on the gospel of long-term value investing, has collected over $1 billion in government subsidies across 310 separate awards funneled through its subsidiaries. These aren't rescue packages for struggling industries. They're additions to the bottom line of companies already generating billions in profits. The subsidy doesn't level the playing field. It tilts it further toward the side that's already winning. The pattern is consistent. At sufficient scale, private wealth and public capital become inseparable. The free market narrative is actively misleading about how wealth at this scale is built and sustained. Tax code is perhaps the most important policy mechanism to understand because it operates through a definitional choice. Tax code is built around income as a flow. Money comes in, you pay tax on it. Your paycheck arrives on Friday, it gets taxed immediately at ordinary income rates before you ever see it. But there's a second way to accumulate economic value that the code treats as fundamentally different: asset appreciation. When the value of something you own goes up, your stock portfolio, your real estate, your business equity, that gain is not income under the current definition. It's unrealized. It doesn't exist for tax purposes until you sell. And only if you do sell, it faces a maximum rate of 20%, not the 37% that applies to a high-earning worker's salary every time they get paid. Here's an example. A nurse earns $100,000 this year. She pays roughly $22,000 in federal income tax. A hedge fund manager's portfolio appreciates by $100,000. He pays nothing. That gain compounds year after year until he sells, at which point he faces a 20% rate on that gain. Both gain the same amount of economic enrichment. Two completely different tax treatments. That's a definitional choice, not a natural feature of economics. A critic will say, but a business owner doesn't actually have that money to spend until they sell. True, but let's be precise about what actually happens at the very top. The ultra-wealthy don't need to sell to live, ever. They borrow. They pledge appreciated assets as collateral and take out low-interest loans. Loans are not taxable income, and the interest they pay on those loans, tax deductible. So not only do they avoid tax on the appreciation, the cost of avoiding that tax itself is subsidized by the tax code. They live on borrowed money, their assets keep compounding, and they're generating deductions along the way. And when they die, the stepped-up basis mechanism eliminates the deferred tax permanently. Their heirs inherit their assets with the cost basis reset to current market value. The capital gains that compounded for decades that were never taxed because they were never realized simply disappear from the tax base. Gone. Not deferred, gone. The argument is that the value of a business can decline or even be wiped out completely, so owners shouldn't pay taxes on unrealized gains because those gains can become losses. And that is a real risk for many small businesses. Markets require the credibility of failure. But let's explore that dynamic when large companies are failing. The logic of the equity risk premium, the reason equity investors expect higher returns than lenders, is that they can lose everything. In 2008, that logic was tested, and it failed in the most predictable direction. Citigroup's stock fell over 90%, but Citigroup didn't fail. It received $45 billion in TARP funds and hundreds of billions more in Fed emergency lending facilities. AIG was nationalized to prevent cascading losses. The executives who built these institutions' risk exposures largely kept their compensation. The workers who lost jobs had no equivalent backstop, just 26 weeks of partial unemployment if they qualified. The asymmetry is the point. When things go catastrophically wrong at sufficient scale, losses are socialized. When things go well, gains are private. That's not a risk premium. That's a subsidy to large equity holders paid by the public, activated when most needed. And how did these too big to fail companies get so big? A key factor relates to antitrust laws and their lack of enforcement. This is possibly the most direct mechanism to tilt the scales. In a competitive market, the process that distributes gains broadly is competition itself. Antitrust law exists specifically to preserve that competition when natural forces aren't sufficient. For roughly 40 years, that enforcement had no teeth. Google controls 90% of global search. It also owns the dominant advertising exchange and one of the largest publisher ad networks, meaning it sits on both sides of the transaction when ads are bought and sold online. The Department of Justice found in 2024 that Google illegally maintained its search monopoly through exclusive arrangements with device manufacturers and browsers. For years, Google paid Apple an estimated $15 to $20 billion annually to be the default search engine on iPhones. That payment didn't make Google search better, it made competition structurally impossible. In 2023, the FTC sued Amazon, alleging the company manipulates its own search results to rank its Amazon Basics private label products ahead of competitors, even when it knows a competing product is higher quality. Sellers who try to offer lower prices elsewhere risk having their products buried or their buy button removed. Amazon controls the platform, sets the rules, and competes against the people paying to use it. Meta, or Facebook at the time, acquired Instagram in 2012 for $1 billion when Instagram had 13 employees and zero revenue. Internal Facebook communications revealed in congressional testimony showed executives viewed Instagram as a competitive threat and acquired it specifically to neutralize that threat. Instagram today would be valued independently at over $100 billion. The acquisition that prevented a major competitor from emerging was approved without serious challenge. They also bought WhatsApp for $19 billion in acquisitions that, in more aggressive antitrust environment, would have been challenged or blocked. Apple controls the only legal distribution channel for software in 1 billion iPhones. Every app, every in-app purchase, every subscription, Apple takes 30%. Not because they built the apps, not because they provide meaningful support, because they own the gate. When a court ordered Apple in 2021 to allow developers to direct consumers to their own payment systems, Apple implemented what the court later called a deliberate scheme to circumvent that order. In 2025, they were found in contempt. The 30% commission remains unchanged. These companies didn't hide what they were doing. They did it openly for decades while getting richer every year the cases dragged through the courts. By the time Google was found guilty in 2024, after a case had started in 2020, the company had earned over $1 trillion in monopoly revenue. The fine was zero. The remedy was behavioral. The monopoly still exists. The intellectual underpinning of this non-enforcement era was a Chicago school consumer welfare standard, which was, if consumer prices are low or services are free, there is no antitrust harm. By that metric, Google, Meta, Apple, and Amazon are above reproach. But that framing measures only one dimension of market health, and it ignores worker harm, supplier harm, the destruction of competitive opportunity for new entrants, and the harm to innovation when a few players control who gets to compete. When competition is suppressed, the mechanism that distributes gains broadly simply stops working. Excess returns don't get competed away, they compound. And because concentrated market power translates directly into political power, The companies that benefit from non-enforcement become increasingly capable of preventing enforcement from resuming. And finally, campaign finance protects all of this, the key mechanism that makes the overall system self-reinforcing. Citizens United, the 2010 Supreme Court decision, held that corporate spending on political campaigns is protected speech and cannot be limited. The practical effect? Corporations and wealthy individuals can deploy unlimited resources to influence elections and legislation. In 2024, outside spending in a presidential election exceeded $4.5 billion. Dark money alone, spending by nonprofits and shell companies that don't reveal their donors, exceeded $1.9 billion, nearly double the prior record of $1 billion set in 2020. The policymaking process that produces all the mechanisms we've discussed is now structurally accessible to concentrated wealth in a way unavailable to anyone without it. This isn't a side issue. It's the mechanism that protects all the other mechanisms. And this brings us to the other side of the equation. Everything we just talked about was regarding policies that add weight to the capital side of the scale. Now, let's look at the other side, because the scale doesn't just tip by lifting one end up. It tips more by pushing the other end down. There's a data point that should anchor this discussion. From roughly 1948 through the early 1970s, about 25 years, worker productivity and wages grew in near lockstep. Workers produced more, they got paid more. That relationship held through Republican and Democratic administrations alike through recessions and expansions across industries. Since the mid-70s, more than 50 years now, those two lines have diverged sharply and continuously. Productivity has roughly doubled. Real wages for non-supervisory workers have grown modestly at best. The 25 years where they track together wasn't an anomaly. It's what labor markets look like when the policy environment is more balanced. The 50 years of divergence since is what labor markets look like when it's not balanced. What are some of the factors that led to this imbalance? Efficient markets require information. Both sides of a transaction need to know what things are worth. Employers have near perfect information. They know every employee's salary, what competing firms pay, and what market rates are for every role. Workers have almost none of that, and that asymmetry is actively manufactured through several mechanisms. Salary secrecy culture. Companies maintaining explicit or implicit policies discouraging salary discussion, treating it as a violation of professional norms. The cultural norm that it's impolite to discuss what you earn didn't emerge organically. It serves one party in a negotiation. Requiring salary expectations from applicants. When an employer asks, what are your salary expectations before disclosing what the role pays, they're extracting information while withholding it. Opaque job postings. Many listings omit salary ranges entirely, requiring applicants to invest significant time before learning whether the compensation is even viable. This asymmetrically benefits employers. Non-compete agreements restrict a worker's ability to take their skills to a competing employer. Originally designed to protect genuine trade secrets, they've been applied so broadly that sandwich shop employees, hairstylists, and security guards have been bound by them. The only purpose at that level is to prevent workers from using their labor as leverage. Many will argue about the enforceability of these agreements, but few workers have the resources to hire legal representation to fight them. Worker misclassification as independent contractors strips employees of minimum wage protections, overtime rights, benefits, and a right to collectively bargain. Uber, Lyft, and DoorDash spent over $200 million in California to pass Proposition 22 in 2020, exempting them from a state law that would have required them to classify drivers as employees. They won. Their drivers, who funded no comparable campaign, lost. Mandatory arbitration clauses in employment contracts remove workers' access to courts. The worker must resolve claims, wage theft, discrimination, harassment, through arbitration, using a process the employer knows better through arbitrators who depend on repeat business from employers. A 2015 study found that employees win only 21% of cases in mandatory arbitration versus 57% in federal court. Removing access to courts is removing bargaining power. Now apply all these mechanisms to a situation where a single employer is the dominant buyer of labor in the community, a monopsony. Walmart is often the primary employer in the smaller communities where it locates. When Walmart enters a market, local retailers close. Workers have fewer options. Walmart knows this and they exploit it. The connection to wealth concentration is very direct. Wages are a cost. Lower wages mean higher profits. Higher profits flow to shareholders. They're capitalized into the stock price. That becomes the net worth of the Walton family, which holds approximately $500 billion in Walmart stock. When wages at Walmart are suppressed below what a competitive labor market would produce, that gap flows upward. And when those wages are so low that workers qualify for public assistance, Medicaid, food stamps, housing subsidies, the cost of that suppression gets transferred to taxpayers. The public subsidizes Walmart's labor model. The Walton family keeps the profits. The standard justification for why workers don't deserve to share in profits goes like this. Workers choose certainty while investors assume risk. There are two fundamental problems with this framing. Workers don't actually get certainty. At giant companies, large-scale layoffs happen not when companies are struggling, but when they want to improve their stock price. In 2025, Microsoft laid off 15,000 workers while reporting over $100 billion in annual profit. Amazon cut more than 30,000 jobs while posting a profit of $78 billion, a 31% increase over the prior year. Oracle just announced 30,000 job cuts with annual profits of $16 billion, while also announcing $50 billion investment in artificial intelligence. These were not companies in distress, but every financial measure, they were thriving. The layoffs weren't about survival, they were about the stock price. Workers who accept lower wages in exchange for stability found out the stability was contingent on the preference of shareholders for a higher stock price. And workers do bear real economic risk. They bear physical risk in dangerous jobs. They bear the risk of technological displacement and industry decline and ownership decisions to prioritize this quarter's margin over workforce stability. They just don't get the upside. That's not a market outcome. It's a reflection of who has bargaining power. And that bargaining power is shaped by policy. Now let's step back and look at what we just walked through. Intellectual property law blocks competition from accessing key technologies, building moats that protect excess returns for decades. Government contracts and subsidies let policy, not markets, determine who survives, making private wealth inseparable from public capital allocation. Tax policy defines income in a way that systematically favors ownership over labor, compounding wealth untaxed from owners while extracting from wages immediately. Antitrust non-enforcement allows monopoly power to compound, turning dominant market positions into permanent structural advantages. The implicit bailout backstop socializes downside while leaving upside private, removing the credibility of failure for the largest actors. And campaign finance converts all this concentrated wealth into political access. And on the labor side, manufactured information asymmetry, non-compete agreements to suppress worker mobility, contractor misclassification, mandatory arbitration, and monopsony power all systematically remove bargaining power from people who do the work, translating directly into higher profits, higher stock prices, and greater wealth for the people who own the companies. Every single mechanism suppresses competition and favors the same side. Here's what makes it self-reinforcing. Once a company reaches sufficient scale, it doesn't just benefit from an existing rule, it actively shapes the next generation of rules. The result is a feedback loop. Policy concentrates wealth. Concentrated wealth purchases political influence. Political influence shapes policy to concentrate wealth more. In 1970, Milton Friedman published an essay arguing that the sole responsibility of a corporation is to maximize shareholder returns. No responsibility to workers, no responsibility to communities, no responsibility to the country that provided its legal existence, its infrastructure, and the education of its workforce, just to shareholders. That idea became the operating doctrine of American capitalism for the next 50 years. It was a philosophical choice made at a specific moment in history by a specific person with specific ideological commitments. Before it, a stakeholder model was more common. The shift to shareholder primacy wasn't economically inevitable. It was an idea that became a doctrine, that became policy. And every mechanism we've discussed accelerated after it took hold. The debate was never free markets versus socialism. That's a distraction. The real question is simpler. Whose interests do the rules serve? The irony, and it's a significant one, is that the people who most loudly invoke free markets are often the primary beneficiaries of the policies that prevent them. If markets truly behave freely, ask yourself, do you really think a single human being could accumulate $800 billion? If this resonated, I want to hear it. Leave it in the comments. I always encourage constructive dialogue.